Gold just printed a bullish Morningstar reversal near 3,900, a powerful signal that could mark the start of a major recovery toward 4,400, or trigger a sharp correction that few are prepared for. But here's the truth. Most traders miss gold's biggest moves because they don't truly understand the forces driving this market right now. In this breakdown, I'll reveal how institutions are quietly positioning, uncover the three main forces shaping gold's next move, and share my exact trading roadmap for the week. If you're serious about trading gold, stay with me till the end as we break down the three macro forces driving gold right now. Macro outlook: three key forces driving gold. Force number one, geopolitical and fiscal risks. The US faces a possible government shutdown. Pressure is mounting on the dollar while gold quietly strengthens as a safe haven. Tensions between the US and Venezuela are escalating as Washington deploys F-35 fighter jets and two B-1 strategic bombers near Venezuelan airspace. In response, Caracas has activated its Book M2E air defense systems, reportedly ready to engage any US aircraft under the pretext of targeting drug trafficking groups. Russia-Ukraine peace talks show some progress, but no deal yet. Until a concrete agreement is reached, uncertainty will keep gold supported as a safe haven. That's just the first force, but the second one is even bigger. The US dollar. Geopolitics steal the spotlight, but the real fight is happening in the dollar. Force number two, the US dollar dynamics, DXY. The dollar remains the most important counterforce to gold. Let's break down its story step by step. DXY technical analysis. Starting with the monthly chart, the US dollar index remains within its long-term uptrend channel. Last month closed as a bullish candle, reinforcing the ongoing upward bias. However, DXY is now facing a strong resistance zone between 99.8 and 101.5, which corresponds to a previous major support area. It may take considerable time and momentum to break above this level. If DXY closes above 101.5, the next upside targets are 104, 106, and eventually 110. Conversely, a monthly close below 96 would open the door for a deeper decline toward 92, 90, and possibly 88. On the weekly chart, after nearly 20 weeks of consolidation, DXY has shown signs of strength. The last 4 consecutive weekly candles have closed above the 20-week moving average, and RSI is turning higher, confirming a shift in momentum. RSI divergence and a move back above the 50 level suggest that the dollar could continue testing key resistances around 99.8, 100, and 101.5 in the coming weeks. Moving to the daily chart, the DXY has delivered 3 consecutive bullish sessions, maintaining its short-term uptrend. Price action is now heading toward the 99.8, 100 resistance area. If DXY breaks and closes above 100, it will form a double bottom reversal pattern, projecting upside targets at 101.5 and potentially higher. However, if it fails to clear 100, we may see a temporary pullback toward 99 or 98 before the next bullish leg resumes. Zoom into the H4 chart. On the 4-hour chart, DXY continues to trade within a rising channel with higher lows forming consistently. The index is approaching a strong resistance zone at 99.5-100, where price previously dropped sharply from 99.8 to 96. DXY might need more consolidation here before attempting another breakout above that key resistance. Here's the catch. DXY's next move won't just impact gold, it could rewrite the short-term trading landscape entirely. Now let's look behind the charts at the institutional flows shaping gold's next move. Finally, institutional activity. While retail traders are still debating whether gold has already peaked, institutional players tell a different story. After accumulating 40 tons of gold 2 weeks ago, Gold Trust has trimmed its holdings by 19 tons last week. In the last 3 sessions, they've only been scalping or taking short-term trades. They're reducing total reserves from 1,058 tons to 1,039 tons as part of a risk management strategy. The fund appears to be waiting for a more favorable opportunity to reaccumulate positions and drive gold prices higher once again. When capital of this magnitude shifts, it's not noise, it's a message. Retail traders often get trapped chasing moves too late, and that's when the real game in gold begins. These actions suggest the fund may still be aiming to drive gold toward 4,200 to 4,400 and eventually 4,700 to 5,000 before taking profits, positioning itself to hedge against a possible Ukraine peace deal and a potential US dollar rebound. Now that we understand how capital is moving, it's time to turn to the charts. Let's zoom in and see what gold is really telling us. Gold technical analysis. First, congratulations to those who followed my October 29, 2025 analysis and bought around 3,900 when the price retested the 3,900 support. You're now sitting on a gain of more than 1,000 pips. That's why it's crucial to subscribe to the channel or join our Telegram to get real-time updates so you don't miss the next major wave in gold. Now, let's break down the gold chart. Monthly, weekly, daily. Step by step, here's what the market is really showing. Starting with the monthly time frame. Gold posted another bullish monthly candle with exceptionally high volume, one of the largest in its historical rallies. However, the candle closed as a bearish pin bar, retreating by roughly 40,000 pips, signaling exhaustion in the bullish momentum. This pullback was driven by a combination of factors: the rebound in DXY, profit-taking from investors, and a temporary US-China trade truce reached late October. Gold may need time to stabilize before attempting another strong rally, but if DXY strengthens further, the risk of a medium-term reversal in gold prices increases. Since bottoming at 1,600, gold has surged to 4,400, a move of nearly 28,000 pips. This rally was fueled by four converging forces. The dollar's drop from 114.6 to 96, geopolitical risks in Ukraine and the Middle East, trade tensions under the Trump administration, fiscal risks, government shutdown in Washington. Ask yourself, how often do we see such perfect alignment? It could take more decades or never happen again. At this stage, peace in Ukraine remains elusive, fiscal risks are still present, and global markets have yet to find solid footing, all of which continue to support gold's upside momentum in the coming weeks. However, a strong rebound in the US dollar, DXY, could easily trigger a sharp correction in gold from current levels. On the other hand, if the DXY continues to consolidate or weaken, gold is likely to rebound to 4,100, 4,200 if break decisively above the 4,200, paving the way for a potential rally toward 4,300, 4,400 and beyond. On the weekly chart, gold is still maintaining its broader uptrend despite recording two consecutive bearish weekly candles with heavy volume. The selling pressure hasn't been decisive as buying interest remains active near the lows. Price continues closing above 4,000, suggesting that gold may consolidate in the short term while tracking DXY's next moves. If gold closes above 4,400, upside targets would extend to 4,500, 4,700, 5,000. If it closes below 3,900, the correction could deepen toward 3,800, 3,700, or even 3,500, where strong demand is expected to re-enter. Shifting down to the daily. Now let's look at the daily chart. This is where the broader story unfolds. Gold continues to correct lower and recently closed below the 20-day moving average. On October 22nd, price formed a beautiful bullish pin bar when testing the 4,000 support zone. However, following the US-China trade truce, gold extended its pullback to 3,900 before rebounding and closing back above 4,000. Notably, a failed breakdown, false break, occurred below 3,900, followed by a strong bullish candle, forming what appears to be a Morningstar reversal pattern. If confirmed, gold could recover toward 4,100, 4,200, and possibly 4,300, 4,400 in the coming sessions. If price breaks below 3,900, the next test would be around 3,800, which aligns with a psychological round number and the 50% Fibonacci retracement, likely providing solid support for a rebound. So, let's zoom into the H4 chart, where things get even more interesting. After forming a double top pattern and entering a strong corrective phase, as we projected earlier in our Telegram analysis, gold now appears to be building a potential double bottom pattern that could trigger a recovery if the H4 candle closes above 40.30. price is currently consolidating within a symmetrical triangle, showing strong buying interest around 3,900–3,920. Gold is holding above the 20-period moving average, supported by over 10 consecutive bullish H4 candles, while the RSI trend continues rising. If momentum sustains, gold could revisit 4,100, 4,150, or even 4,200 in the coming sessions. However, failure to break 4030 could result in another short-term retest around 3950, 3960, or even 3900, 3920 before the next upward leg. Keep in mind, gold has already corrected nearly 5,000 pips from 4,400 to 3,900, so a technical rebound of at least 50% of that move toward 4,150, 4,200 is a reasonable expectation.
This structure gives traders a clear multi-time frame view. Overall structure remains bullish, with the current pullback seen as a healthy correction within the uptrend. All of this leads us to the key question: why consider both buying and selling gold at this stage? Gold stays in a strong bullish cycle, supported by institutional demand and solid technical setups. However, the DXY rebound remains a key headwind to watch. Let's turn that analysis into a practical trading plan, the exact playbook I'll be following for the week ahead. Trading plan, November 3rd through 7th, 2025. First buy zone, 3,800 through 3,825. Institutional support, round number, FIBO 0.5, daily, probability approximately 90%. Stop loss, 37.89. Targets, 38.47 through 38.97, short, 39.47 through 39.97, mid, 41.47 through 43.77, long. Second buy zone, 38.80 through 39.25. H4 support, round number, plus fail break, approximately 90%. Stop loss, 38.77. Targets, 39.47 through 39.97, short, 4,027 through 4,097, mid, 41.47 through 43.77, long. Third buy zone, 39.50 through 39.75. H4 MA20 support, round number, probability approximately 85%. Stop loss, 39.45. Targets, 39.97 through 4,027, short, 4,046 through 4,097, mid, 41.47 through 41.97, long. Fourth buy zone, 39.87 through 39.93, intraday. Nearest support, probability approximately 80%. Stop loss, 39.86. Targets, 4,007 through 4,027, short, 4,046 through 4,097, mid, 41.47 through 41.97, long. If you're still watching, you're already ahead 90% of traders. First sell zone, 41.40 through 41.50, H4 strong resistance, probability approximately 85%. Stop loss, 41.51. Targets, 41.31 through 41.03, short, 4,053 through 4,003, mid, 39.53 through 39.13, long. Second sell zone, 41.80 through 41.100, neckline resistance of the double top pattern, probability approximately 90%. Stop loss, 41.01. Targets, 41.51 through 41.03, short, 4,053 through 4,003, mid, 39.53 through 39.13, long. Third sell zone, 43.77 through 4400, all-time high, probability approximately 99%. Stop loss, 44.01. Targets, 43.53 through 43.03, short, 42.53 through 42.03, mid, 4,053 through 4,003, long. Pro tip: false breakout, wait for the retest, re-enter for clean profits. Remember, probabilities don't guarantee outcomes, but they keep us disciplined. Gold doesn't move randomly, it reacts to real global shifts. This move hasn't even started yet, and this is your chance to be early. Don't follow the crowd. Trade with clarity, not emotion. Subscribe to Gold Mastery and join our Telegram to catch the next major move before it begins. Master gold, master the market. Trade smart. This is not financial advice.